Here at PPC Ian, we are now 40,000 dividend investors strong. That is right. This dividend investing community has grown to 40,000 community members. Our community is larger than a lot of smaller cities around the world, and I'm so excited about that. I want to celebrate this milestone by answering some subscriber questions today and also discussing some recent dividend stock purchases that I just made. So get ready, it's going to be another exciting video. So I just purchased more shares of Johnson & Johnson and Caterpillar. These are two stocks that I recently discussed on this channel. As I head into the end of this year, I am laser focused on a short list of stocks. I'll link in the description below to the video where I discuss these stocks. These are stocks that I believe are current values in the market right now. And JNJ and CAT are at the top of that list. They're great values. I'm going to share some statistics on the screen in a minute as to why I think they're good values right now. But it was exciting to add to these stocks. J&J is my number one, so I always enjoy adding more shares. But with Caterpillar, it's not like a top 10 stock or anything. It's a nice supporting stock. I like Caterpillar. I like the fact that it gives me industrial exposure, which I could use more of. And I don't believe I've been adding too much of this stock. I didn't look back at my transaction history, but I don't buy Caterpillar very frequently. In fact, this may be one of my only net new purchases other than reinvesting dividends in 2019. So it's nice to add some more CAT because I just don't do it that frequently. And so I own 43 stocks, and some of those stocks, I don't add to them too much. So when I do, it's kind of fun. And so I enjoyed adding to that. So I want to share on the screen with you some cool stats from J&J and Caterpillar. And so with J&J, I was fortunate enough to buy at $129.78, and so nice purchase price on J&J. It's down because there are a lot of lawsuits against the company right now, and in fact, there's more drama as it pertains to the talc powder. Apparently, the FDA found a bottle of this talc powder and was testing it, somehow found asbestos in it, and so J&J recalled all that talc powder. They're looking into it. J&J, on their end, claims that they have quality control practices in place to make sure that their talc powder does not contain any asbestos, and so they regularly test for that. And so they're saying, hey, we need to make sure that the FDA looked at a bottle that is authentic, that was not tampered with, that was, we need to make sure that the FDA's testing policy was not somehow tampered with. And so there's going to be more investigation. But long story short, everyone loves to kind of go against this company right now. Everyone wants their money. Everyone wants the shareholders' money. But you know what? You ain't getting it. And so J&J, I love this company so much. Number one favorite stock. And the earnings per share estimated for 2019 is $8.68. And so if I take $129.78, which I just bought my shares at, I divide by 868, I get a PE of 2019 of a 14.95. Buying a world-class company, there's that is so good as J&J at this kind of PE is amazing. Now, obviously, there's some risk there. Like I said, society is changing. We're in a society right now where everyone wants to find someone to blame this or that. And look, I don't want to downplay the fact that someone out there with medical issues, medical concerns, my heart goes out to you. I wish everyone all the best. But I'm just saying sometimes in the market out there, in the media, because of social media, because of the world we live in, it seems like a lot of these things get blown out of proportion. And it seems, quite frankly, like there's so much of the blame game. And so that's why I am on the side of J&J more so than anything. But I do wish if there were mistakes made that everyone gets compensated appropriately. And obviously my heart goes out to everyone as well who may or may not be affected by these treatments that J&J brings to market. Now, J&J's dividend is $3.80. They pay 95 cents quarterly, so it's $3.80 a year because there's 4 quarters in the year. If I take that, I divide by my purchase price, my starting yield is a 2.93%. Not very high. not bad. I like the payout ratio there because that payout ratio on 2019 EPS is about 44%. So there's a lot of room to grow the dividend over time. And in fact, the 5-year compound annual growth rate of the dividend is a 6.3% on average per year for the last 5 years. And I think that will continue in perpetuity. There's a lot of room for J&J to increase that yield. And so, like I said, in a nutshell, I've talked about this stock a lot. There's risks with it, don't get me wrong. But here's the way I look at it. It's my number one stock. Even if it gets cut in half, I own 43 stocks in my portfolio. I'm well diversified. So even if it gets cut in half, I can shoulder that. I'm not worried about that. And so that's why I diversify. But I don't think that will happen. And I love to run towards stocks that are facing some drama. Here's another way I want to put it. This is a theme I want to share in the video today. This is kind of a new theme. I haven't talked about this on my channel before, so I want to add some net new value here. If you look at J&J right now, forward PE for the year 2019 is about a 15. It's 14.95. In other words, the shares I'm buying at $129 and change, it will take 15 years of earnings to basically pay back for what I'm buying. And that's assuming that the earnings stay flat, that they don't grow. I believe they will grow. But when I buy stocks, I like to look at them conservatively. And so a lot of us out there, we use PE ratio. I love using PE ratio, price to earnings ratio. But sometimes when you're using PE ratio, you just kind of forget what's behind it. You forget about why you're looking at the PE ratio. And you start just thinking, oh, it's a 15 versus a 20 versus a 7. And you're like, hey, the lower the better. But you're not thinking in depth what's really behind it. And what's really behind the PE ratio is it means for the price I'm paying, this is how many years it will take of earnings if the earnings stay the same to basically compensate for the price I'm paying. And so J&J, world-class company, 15 years of earnings will equal the price. All right, I can live with that. And so you'll see as we go on, I'm going to talk about McDonald's later. People asking me, Ian, are you buying McDonald's here after they had their poor quarter of earnings, after the stock's down today? I'm going to talk about that because you'll see a difference between J&J and Caterpillar, the types of stocks I am buying now, and McDonald's, which is trading a lot higher. And so for me, I usually feel good if PE ratios, it certainly differs by industry, pharmaceutical, healthcare industry, like stocks like J&J and AbbVie, it tends to trade lower because there's more risk with these companies these days because of the society we live in. But anyways, it's putting all that aside, I like owning something with a PE of 15 that's world-class because I can live with that. 15 years, I can kind of see that, not too far away. I can see that in the future that, hey, after those 15 years, the earnings basically pay for what I'm buying. So just another way to look at PE ratio that I think we forget sometimes, that I think helps, for me at least, put things in perspective. So I want to share Caterpillar as well. This is another stock that I bought, and I added more shares. I added them at $131.56. This company is expected to earn $11.70 in 2019. If I take the share price I paid, I divide by that EPS, I get a PE ratio of 11.24. So in other words, it will take 11.24 years of earnings. If they stay the same they are, I think they will grow, although they may go down because it's cyclical before they go up. But more or less, I can live with that. 11 years of earnings to pay for what I'm buying. Yeah, that works. And so I love buying stuff at PEs in this range. And so dividend is $4 and change, $4.12. Starting yield is a 3.13. And I don't show it on the screen, but the payout ratio is a healthy 35%. So there's a lot of room to increase the dividend. And they have to do that because earnings can be more volatile given that it's an industrial company, given that we have trade wars and we're at the end of the economic cycle. And so it's good to have a lower payout ratio with this company. Earnings can be more volatile, but I think that volatility is priced in with a PE of 11. In other words, earnings could get cut in half and the PE would only jump up to a 22, which I think would be a reasonable PE for a company like this at the bottom of a bear market, at the bottom of a cyclical downturn for industrials. And that's why I can rationalize buying Caterpillar here because I don't think their earnings would get cut in half. But even if they do, which would be reflective, again, of an economic downturn, reflective of the bottom, really, of a cyclical downturn for this industrial company. PE of 22, not so bad. And so for, again, world-class blue chip company. And so that's why I like buying right now. Dividend yield is a 3.13%. And what I like about this is the compound annual growth rate of the dividend is a staggering 8%. On average, for the last 5 years, they've grown the dividend by 8% per year. And the reason they're doing that is because of that hugely impressive payout ratio, which is only 35%. They have a lot of room to grow that dividend. And I think that 8%, it will continue. It may not be as high in future years because I think they'll be conservative due to economic timing, but they've got room over the long run. And so that's the two that I just bought. A lot of this is a repeat of some of my prior videos, but I just wanted to give that background because I think it's important to reinforce why I'm buying these companies right now. And so that's what I'm doing. I love to put my money where my mouth is, so to speak. And quite frankly, I'll tell you something. A lot of these stocks that I am targeting to buy for the rest of the year, they're starting to trend up. And so one of the reasons I just kind of jumped at both JNJ and also CAT is out of my short list. Those are probably the only two, quite frankly, that have not surged in price recently. And so I'm just trying to add to them before they start going up, because you never know when these stocks will start going up, because some of the others that I want to buy more of, Altria and 3M, for example, and AbbVie, those stocks are surging in price, especially AbbVie. I'm glad I built my full position in AbbVie quickly because it's just surging. Now, on a related note to those other three, I'm still going to buy. I set forth my strategic goals for the rest of this year. I'm going to probably be buying. I'm definitely going to be buying those three, AbbVie, Altria, and 3M. Three of those three, 3M has surged the least. It's really AbbVie and Altria that have surged in price. But you know what? Relatively speaking, they're still good values. And I think as dividend investors, sometimes we all lose sight of that. I was on the phone earlier today with my good buddy from college, and we were actually discussing this very topic, that dividend investors, it's easy for us to buy when the stock price is going down. And that's precisely what I did with AbbVie. This thing just tanked, bought shares down, down, down. Love it. But sometimes we have trouble buying when it's going up. But what I want to do for myself and also for the community out there is to kind of put this concept forth that, yeah, the stock chart, it's nice and all, but regardless of whether the stock is going down or up, I like to look at the metrics like I'm doing right here for JNJ and Caterpillar. And even a stock that's gone up, we'll see this. I'm going to talk about IBM a little bit later. Value can still be there. And so that's what I'm trying to say is with Altria, AbbVie, 3M, look, yeah, they're up from the lows, but is the value gone? Heck no. They're still in the ballpark of those relative lows. They have a long way to go on the way back up. So putting the chart aside, just looking at the numbers, there's still value there. And so I'm excited about those three as well. But that's the 5, by the way, I'm targeting for the rest of this year. So I want to jump in now actually to IBM. I got some questions. And so, by the way, celebrating 40,000 subscribers, I want to truly thank everyone in the community. I love you all so much. And thank you so much for your support throughout the years. I had a goal this year, 2019, of hitting 100,000. But I'll tell you, you set your goals for the stars. You come up even a little short, you're still hitting amazing milestones. And look, I may not hit my 100,000 this year, but hitting 40,000, this is a true blessing. I am so grateful. I just want to take a moment to really thank you all in the community. I love this community so much. And so one of the things I did is I have a Facebook group now, and on that Facebook group, I get a lot of good questions. I'm going to link to the Facebook group in the description below if you want to join. And one of the questions was, hey, Ian, IBM, they had bad earnings. What do you think about it? And so I want to talk about that, and I'm going to share some stats on the screen. I'm going to share some takeaways from the earnings on the screen. And so first, takeaways from the earnings. What happened? Their adjusted revenue was down 0.6% year over year. And I think this is the 5th quarter of declining revenue. And so this has become a trend for IBM that the analysts, the street, hates. This company, it's not growing top line revenue. It's been down for 5 quarters straight now when you look at the comps year over year. But it's not down that much. When you really look at it, it's only down 0.6% year over year. So I look at that more as flat revenue, but the street doesn't look at it that way. And what's happening? This is a company in transition. They have a whole bunch of new products. They made a Red Hat acquisition. They're in cloud computing now. They're in quantum computing. They're in artificial intelligence. They're in blockchain. A lot of these new initiatives are smaller, but they're growing quickly. Red Hat, for example, revenue growth was up 20% almost year over year. It exceeded expectations, but the revenue base there, it's still kind of smaller. And so it's not enough to push the whole company revenue growth, but it will be. It will be at some point. And so some of their legacy business, they're seeing weak growth, for example, in the global technology business. And so some of the more legacy stuff, it is taking some time. But eventually, my hypothesis is the new stuff will get big enough where it counteracts the old stuff and you'll see revenue growth for the whole company. But in the meantime, let's talk about this. They have free cash flow over the last 12 months of 12.3 billion. And they have, and this isn't cash from operations. This is free cash flow. And IBM came out and said in their recent earnings report that they expect going forward an annualized free cash flow to continue in that $12 billion range. They used, in fact, $7 billion of that cash flow to reduce debt already. They racked up some debt, obviously related to that huge Red Hat acquisition. They're using their cash flow, their free cash flow, to pay that down. And so that was really nice to see. And so I want to just pop some stats on the screen here about IBM. Stock is down. Everyone hates it. I especially sense this, I would say, in the Silicon Valley, even at PPC Ian meetups. I know we're overdue. I got to do one. For all the Thug Life investors out there, all the local crew. I'll link in the description below, by the way, if you want to sign up for the local crew, get alerted of local meetups here in the Bay Area and Greater California area. I know Sacktown folks, I owe you a meetup as well. I'm going to get some meetups done before the end of the year, so stay tuned. We're going to have some good ones this year before 2020 comes. And so, anyways, I did a meetup in San Jose. 2 amazing subscribers were there, and we were talking about stuff like IBM. And I think general consensus is, hey, in Silicon Valley, people don't really look up to this company. They kind of look down on it a little bit, and you're kind of an employee and you're wondering where to work. Should you work at like Alphabet, Google? Should you work at like Facebook or Amazon or one of these newer kind of cooler companies, Tesla, for example, or do you want to work at IBM? The average employee, when they're evaluating their choices, unless they can make a lot more money at IBM, they're probably going to work elsewhere. And, I honestly agree with that. And I think that's one of the challenges that IBM probably will face is with talent and with just kind of recruiting, because when it comes to tech, you're always innovating. You have to hire the best of the best. And so that's why sometimes I love my consumer companies a lot more, is they don't have to innovate quite so much. They've got those sticky brands that we all need. But anyways, IBM, let's look at the stats. The stats are pretty darn good. At a share price of 133 and change, with an EPS estimate of 12.80 for the year, their PE right now is a 10.47. In other words, if earnings don't grow, who cares? You kind of use your earnings, you pay for what you're buying in 10 years' time. Not very bad at all. And that PE goes down to a lower 10, a 10.05 for 2020. What I like about IBM is the dividend is $6.48 per share, which is a payout ratio of about 51%. So pretty conservative, which is good because they have a lot of debt to pay down. I don't expect the dividend to increase quite as much going forward. I'd rather see them use the money to pay down debt. But that said, the compound annual growth rate of the dividend is an 8%, so very high growth rate on the dividend. And that starting yield of 4.84% is fabulous. So look, dividend doesn't grow much. I don't care. Buy IBM shares here, and I get my money working for me right away at that 4.84. And so I want to just look at things. So IBM, I don't know, is trading a bunch higher, is up in like the 140s or something, and now it's down at 133. It's plummeted on the news, and people are wondering, is it a good buy? Is it not a good buy? My gut reaction, quite frankly, before I did this analysis, and this is one of the important takeaways from this video and why I wanted to talk about stock charts and how stock charts are sometimes misleading, is my gut reaction is no, it's not a good buy. Why? Because just last year, back in December of 2018, it was trading at $110. Did I buy it back there? No, I did not. I wanted to, but there were so many other alternatives on the table that I didn't get around to buying Big Blue. But I did buy some Big Blue back in October of 18, and I bought it for 130 and change, basically where it is now. By the way, I bought shares as high as 151 and change, and I bought that in 2016, in November of 2016. And so I've bought between 130s and 150. But again, it's kind of in the lower end of the range of where I've historically bought. But my gut, because I do look at stock charts just like all of you do, my gut told me, Ian, it's probably not a good buy because it's not as low as it was in the December of last year. Okay. This is where stock charts are so misleading, because if you just look at the numbers and you look at the raw data, the PE is a 10. And so, yeah, the company's not growing. I think it eventually will. I like the Red Hat acquisition. I like that they're paying down that debt. I like all of the initiatives they have. I think they're going to have some troubles on the personnel side. I tend to agree with my other community members out there when we were discussing, is it kind of cool to work for IBM? Probably not compared to working for Alphabet, for example. But oftentimes what I like to do as an investor is I like to put the chart aside. I like to put even my historical purchases aside, because I know that kind of influences me as well. And let's just look at the raw data. And so that's what I was discussing on the phone with my buddy today. And so that I think that's a really good takeaway for everyone out there just to ponder, because I know a lot of us tend to get caught up in the charts. But the question goes now, Ian, are you buying IBM here? I am not, and I'll tell you why. While I think it's a pretty good value, I would probably be, again, more enticed if I got that PE even lower, which would happen if it dipped down to December of last year range. That said, that's not the main thing, quite frankly. The reason I'm not buying now is really twofold. I have 5 strategic stocks I want to focus on for the rest of the year. I don't want to add number 6. And so that's one reason. The other reason, though, quite frankly, is I own 43 stocks. Some are core, some are medium, some are small, ancillary. IBM's kind of, I don't remember what bucket I had it in, probably like between a medium and an ancillary, somewhere in that range. Definitely not core. But I'll tell you, when I think about IBM, I just don't get excited. I'll give you an example. We rarely watch TV, but last night I was doing some work late at night, and my wife and I watched a TV show together while I was kind of doing some work for my job. And hack, by the way, I'll tell you all, I hope my boss doesn't see this, but sometimes if you want to make a good impression at work, send out some emails a little bit later at night. I was sending that email out probably around midnight last night, and just shows the company you're working kind of late. So just hack out there for all of you trying to make a good impression at work. But anyways, we were watching TV, and lo and behold, what happened? There was an advertisement come up for your Humira. I call it Humira. I call it what I want because I own the company. Thug Life Investor, AbbVie, I love you. But anyways, oh my God, I started doing the happy dance. I see this commercial. My wife is like, whoa, you're kind of crazy. And I know I am, but I start smiling. I'm doing the happy dance. I'm like, yeah. And I'm just telling you, there's a passion meter for me. Like for certain stuff, look, I'm buy and hold forever time frame, 200 years more, 500 years, whatever it is. And so multi-generational. When I look at these companies, I just have, for whatever reason, I don't believe I've used any of the products that AbbVie makes, but for whatever reason, I see the commercial on TV. I just feel good about owning it. And then obviously the numbers back it up. When I bought most of my shares in AbbVie, PE on a 2019 forward basis was in the 7s. Now I think it's up in like the 8-9 range, which is still good. But I'm already up. It's skyrocketing. I hope it comes back down because I'd love to buy more. But even at the higher prices, I'll buy more. I got nothing but love for you, AbbVie. But anyways, I had this kind of attraction to it when I saw it on TV. Now, let's say I saw a commercial for IBM. Am I getting excited? Not really. And so that's what it comes down to as well. IBM plays a role in the portfolio. I like it. But at the end of the day, there's just kind of that. There's the fundamental analysis, which always is first and foremost for me. And there's the qualitative analysis as well, which accompanies it. So the fundamentals, like literally looking at the numbers. Like I did a deep dive in my last video, ton of numbers, cash flow stuff. Check it out. I'll link in the description below. There's the qualitative stuff too, though, like just like, hey, is IBM going to attract the right talent? But then there's kind of this third factor, which is like almost the emotional factor. And I just don't have the emotional factor for IBM. Maybe, hey, Ian, you don't have the emotional factor. Should you even own it at all? Yeah, because I like it good enough. But I'm just saying it ain't no AbbVie. I don't jump up and start dancing when I see the commercial on TV. Just how it is. So it's really for those reasons that I won't be buying more this year. But I think it's a reasonable value at this PE right now of 10. And quite frankly, my position in IBM has already been brought to size. I got enough in it, so I don't necessarily need to add more. Now, I know I'm going to get some critics who are watching the video and don't like this kind of emotional side of investing. But the way I look at it is I'm buy and hold forever. And to be able to do that, there has to be an emotional attachment to the stocks. And to be a successful dividend investor, more so than anything, it involves deploying a lot of money in the market and staying committed in the ups and downs of the market over the long run. And to do that, there has to be that emotional attachment. Anyways, that's what I got to say. That's my piece. That's what I got to say on IBM. So I want to transition now into another subscriber question on McDonald's, one of my favorite stocks of all time. I love these guys. Awesome company. Has been doing quite well. I love the fact that they're getting into the tech business. They've been acquiring some tech companies to streamline their operations. They're forward thinking. I've owned them for a very long time. In fact, I bought McDonald's back in 2011. That's when I started, and I bought it $73.53. It's now trading at $1.99. And so what happened with McDonald's? I'm going to share some info on the screen right now. They announced earnings today. And the earnings fell short. They were short of estimates, analyst estimates, for the first time in 2 years. And so earnings per share, they came in at 2.11. Analysts expected 2.21. So it's lower than estimates. But it was up from last year. It was slightly up. Last year was at $2.10. So they came in at 2.11 versus 2.10. Not really good. You'll see why in a minute. It would be good if their PE were a 10 or 15, but not at their current PE, which is a 25. We'll talk more about that. Same-store sales are up 5.9% versus 5.6% expected. And so global same-store sales are growing at a higher clip than analysts expected. Basically, what's happening with these guys? And so the revenue, by the way, it was $5.4 billion versus $5.5 billion expected, and it was only up 1% year over year. And so basically, analysts expected higher revenue growth. Analysts expected higher earnings per share growth. It's not coming in. And McDonald's, I think they were citing competition in the marketplace, and they were also citing the fact that some of their marketing and incentives and promotions weren't driving the results that they were hoping for. They've been through this before. Just when I've owned McDonald's, it's had its ups and downs. So they will no doubt get through this. I don't have a concern in the world. None, zero, no concern. But some people do. The stock was down today. It had a nice little drop today. But I want to talk about this. I'm going to show some numbers on the screen now that reflect where McDonald's is from a fundamental valuation standpoint. So the price per share is $199. I think it dropped like 5% or something today. Some nice drop for McDonald's. The estimated earnings for 2019 are a 7.95. I take the price per share, I divide by that, I get a forward PE of 25. Taking it back to the beginning of this video, what does that mean? It means it will take 25 years of earnings, if the earnings don't grow, to pay back for the price of buying the share of McDonald's now. And quite frankly, earnings are not growing based on the most recent quarter. And so this is where things start getting put into perspective. They're telling me that revenue's up 1%. They're telling me that EPS is up 1 penny. But the PE is 25? No, there's a disconnect here. You can only have a PE of 25 if earnings are through the roof, quite frankly. They better be growing, 10% year over year. Nice clip. And so this stock is just priced to perfection even after the drop. It's already dropped a bunch. And so dividend is $5. It's $1.25 a quarter, 5 a year. Dividend yield 2.51. One thing I'll say is that compound annual growth rate is just a staggering 8%. But with a payout ratio here of 63%, I don't know if that dividend growth will continue, especially now that earnings are slowing. And look, this is only one quarter. I usually don't put a lot of value on these quarterly reports at all. I just like to look at annual. But honestly, I like looking at the quarter just because I'm a dividend investor. I enjoy staying up on this stuff as well. And I get questions from the community, so I got to dig into it. By the way, my historical McDonald's purchases. I bought some at $73.53. That was my first buy back in 2011. And I bought more. My most recent buy, other than reinvesting dividends, was back in 2018, in August of 2018, and it was at 161 per share. It's at 199 here. And so again, I don't want to look at charts too much, but I'll tell you this thing, even after the drop, it's way up from anywhere I've bought. Now, I've been reinvesting dividends, but I'm talking about net new money buy orders. Even more so than charts, just look at the PE. Even after the drop, the PE is still a 25. And so people are asking me in the community, Ian, are you buying McDonald's here? Is it a value? No way. I'm not buying here. Maybe I'd buy if it got down to 161. If it got down to 161, that'd bring the PE down to 20. Even at 161, it's expensive at a PE of 20. That'll take 20 years to pay back if the earnings don't grow, and they will grow, but I'm just saying 20 years. Whereas we were looking at IBM, what was that? 10 years. What was JNJ? 15 years. CAT, 11 years. And so I'm just saying AbbVie, it's kind of like an 8-year range. Now, McDonald's, is it more premium than these other companies? I would argue it's up there with J&J. Look, McDonald's is my number 3 favorite stock. J&J, to me, maybe it's losing some of its premium qualities because of the litigious society right now. And so maybe it's a little less premium than McDonald's. I still hold it as my number 1. Maybe McDonald's warrants a higher PE because of that. But 25? I don't know. I would feel better buying around at 18. Quite frankly, that's kind of the range 3M is trading in on a forward basis, kind of that 17, 18 range. And so maybe McDonald's around a 20 I'd add more, but 25, no. Now, a caveat. I already have a huge position in McDonald's, and so I don't need to add more. And that's why I like owning 43 stocks, because I can look at the whole portfolio and I can dial in and add where the value is. And that's why I've picked my 5 for the rest of the year. And so the 5, again, are AbbVie, Altria, 3M, J&J, and CAT. Those are the 5. Now, I may add in some Cedar Fair there. I'm starting to like Cedar Fair now that the Six Flags thing didn't work out and the shares price coming back down. I love it. So that one I might add a little more to. But McDonald's, it's not a strategic buy for me now because it's not part of that value list. But look, if I were just starting over again and I was building my portfolio from the bottom up, I would potentially add some McDonald's here just because I'd want it. I'd want to own it because I love it so much. And it goes to that emotional side again. And that just getting started with quality side of things too. But I've already got McDonald's. I got my foundation. I've got the quality. My portfolio is built on quality. And so I don't need to add more here, but it's different for everyone. Everyone's in a different situation. Everyone's portfolios of different size. Everyone is at a different stage in their journey. And I'm just saying, if I were in the beginning stages, I wouldn't be so tied up in value at all. I would be tied up in building my foundation and getting the best quality stocks in the foundation. And I talk about this in my video, How to Invest 10,000, hypothetically. If I was starting over, I'll link in the description. That's how I'd be thinking. And so, look, if I were just starting out, I'm trying to add quality, I see McDonald's dip a bit, yeah, I'd get excited about it. I would. But for me right here, given where I'm at, where I already own some, I just can't get excited at a PE of 25. It's just pretty rich. It's a rich valuation. And I just start thinking, hey, 25 years of earnings to pay back if it doesn't grow what I'm buying, that's expensive. anyways, that's kind of where I'm at right now with McDonald's. But again, my personal situation. So before I leave today, I want to answer another subscriber question. And so this is one where there's a lot of news right now in the media. I get a lot of questions about this. And this comes down to these free commissions. And so it's so interesting that you have these disruptive apps out there, these disruptive companies, and they were offering investors free commissions. It was basically enticing a lot of new investors, millennial investors, to start investing. And so those portfolios are awesome because of that. But some of the incumbents of the world, the bigger traditional brokers, like Charles Schwab, for example, they kind of realized, hey, we want to attract these millennial customers too. Anyways, long story short, most of you know this by now, but a lot of the big brokerages now, they've decided to go zero commission, just like some of the apps of the world like M1 Finance. And Charles Schwab took it to the next level and said, hey, in addition to adding no commissions, we're going to allow you to buy fractional shares as well. So if you don't have enough money for a full share of, say, McDonald's even, which is trading at $1.99, say you want to buy half a share for $100, Charles Schwab is going to let investors do that. And so that's pretty cool. And so people ask me, Ian, what do you think about this? Personally, from my personal situation, I don't care at all. I just don't care. I don't mind paying commissions. And so I'll share in my description below a video I did on this a while ago. In general, my theory on commissions for dividend investors, because I buy and hold forever, is it's one and done. It's not a recurring thing. You pay one time, you own it, bam, done. And so commissions to me have never been a gating factor. They've never been kind of this factor that disappoints me. There's a lot of propaganda out there about why commissions are bad. The reason for that is it's a lot of index funds trying to sell investors on why you should go with an index fund and not a traditional mutual fund. And the propaganda, it actually is legitimate because most traditional mutual funds, they have recurring commissions each year, and that compounds over time. And so those types of commissions are bad. But when you're buying individual stocks, you're buy and hold forever, one and done commissions, never been a big deal for me. Don't really care. All of that being said, I am all for saving money. And so I'm happy here that I won't have to pay commissions on this stuff going forward. So that's good for me. It's good for other investors. Awesome. It's nice that these big brokerages are stepping up to the plate. Now, that being said, I want to bring a word of caution to the investing community because I think everyone, they get so excited by this stuff, but I'll tell you there's two downsides to this. There's two downsides. I think one downside is record keeping. If someone makes too many purchases, say really small purchases, the amount of transactions could go through the roof, and just the record keeping for that becomes overwhelming. And now obviously the brokers keep all the records, but I like to keep my own records as well, and I like to model stuff. I like to see what I'm doing. If I have too many transactions, it's just hard to manage. And so that's one. Two, I think sometimes when there's no commissions, it's more tempting for an investor just to go out and make a lot of transactions, and sometimes to buy stuff without fully thinking it through. Because, hey, no commission, I don't necessarily need to invest more money. And when I don't have to invest so much money and I'm investing less, does that mean I'm going to put less analysis, less effort? Maybe. That's a risk, I'm saying. I don't know if I would do this or not. I don't know if folks out there would do this or not, but I'm saying this is a risk that I can foresee, that because of no commissions, because of smaller purchase order sizes, the risk that I see is investors may not put as much fundamental analysis. And so I just want to say for all of you out there, put in the work no matter what size tranche you're buying, because it's that analysis that really adds the value and makes sure that you're buying the right things and you're buying the things that are right for you. You're buying the things that you're going to stay committed to for the long run. Because again, the biggest and most difficult, most important thing for dividend investors is, in my opinion, the time element, the dedication element, the staying in the game element. And that's only possible when we all make the right decision for us. And everyone's decisions will be different. It'll be unique to the individual case, but it has to be the right decision. And the right decision only happens when you have conviction. And that conviction only comes when you do the analysis. And so historically, I liked buying, I like buying frequently because I always like buying. It keeps me in the game. But when I'm buying, I don't want to buy too small. I want to kind of have enough money where it's like, hey, this is meaningful. It's a meaningful amount of money. And making this decision to put this meaningful amount of money in the market, it's an important decision to me. And so it always kind of added that element of checks and balances to make sure I'm doing the best possible decision with my money at that time. And again, I'm saying the risk. Now, there's no commissions for most investors out there, is that investors just get carried away with too many smaller transactions and maybe forget to do as much analysis. So for me, nothing for my strategy changes. Am I going to make more purchase orders? Heck no. I like to buy usually on kind of like a weekly basis. I like to stay, or at least every 2 weeks, I like to stay in the game, but I need to make sure my purchases are big enough, like I said, where I'm parting with enough money, that it's meaningful, that it has those checks and balances, where I feel like, hey, I gotta be careful to do the right thing with my money here because it's enough money where it's meaningful. And so that's how I look at it. My strategy does not change at all. But what I wanted to say out there is I'm excited. I think this is good for the industry. I think it's going to attract more investors. I feel kind of sorry, honestly. I've never been a huge fan of all these apps, but I am from the standpoint that they got a lot of new investors into the game. And I think they did that. But at the same time, I feel kind of sorry for them because this is also a classical example of business, why I invest in big blue chip companies. Look, I've done some angel investing as well, but in general, my strategy, you guys know it, you see it here on YouTube, 43 stocks, big blue chip companies. Why do I do that? I do that because big blue chip companies have defense. They have defensible moats. And this is a prime example of how investors, or even someone trying to start a smaller company, it's so difficult. It's so difficult because what's going to happen to these apps? Look, I already know. I see folks on Twitter that I follow. They're like, hey, I'm moving my funds out of XYZ app. I'm moving it over to Schwab. And so obviously this is the natural choice that would probably make sense for a lot of people because now it's the same. And which one is better? Which one has a better platform? I don't know. I haven't used these apps, but I would tend to guess that for a lot of people, it may be Schwab. And so I believe these smaller apps, they're going to suffer. And some of them, they may not even last over time. And so my heart actually does go out to them because this just goes to show it is so hard to start a small business and it is so hard to invest in smaller business. And so that's why from an investing standpoint, for my buy and hold forever, for my multi-generational strategy of dividend investing, I like to stick with the big companies like J&J, like McDonald's, like AbbVie. They got staying power and it's hard. It's hard for the smaller companies, but some of those smaller companies, it does work. Look at the Alphabets of the world, so that's an example of a company that was small that has been hugely successful and now is one of the largest companies in the world. But it is so hard. It is so hard for these smaller companies. But there's a lesson to be learned there. All right, everyone. So thank you for sticking with me today through this video, this celebration, 40,000 strong. Shout out to the Thug Life investors who have been there since the early days. I love you all. Thank you for your support. Shout out to everyone, quite frankly, who's part of the community. It means the world to me. So much effort goes into these. It's actually late at night right now. Again, I've been really busy at work lately, but I realized my videos, they're kind of a little bit delayed these days. So I'm trying to make them longer. And look, I just had to stay up tonight to get this one done. So I'm doing it. I'm up late in the garage making it happen here in my garage. And so before I go, in terms of full disclosure, I'm Long Johnson & Johnson, ticker JNJ, Caterpillar, ticker symbol CAT, IBM, ticker symbol IBM, McDonald's, ticker symbol MCD, Altria, ticker symbol MO, Thug Life, AbbVie, ticker symbol ABBV, 3M, ticker symbol MMM, and Cedar Fair, ticker symbol FUN. I own all of those in my stock portfolio. Also, I'm not a licensed investment advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Just sharing my journey here on YouTube for fun and entertainment. More disclosures, disclaimers in the description below. All right, everyone. By the way, I have a really special video in store for the next one. It's a popular subscriber request I've had for a long time. It's going to be a serious one, so get ready. I'll see you in the next video.